Most of my money is invested in diversified portfolios, more similar to the way the magic formula works. And that's because that's a full-time job. We run a big research team, a big tech team to implement those portfolios. Some of it's long short, some of it's long only. I also have concentrated positions in some really good businesses that you would know, like Google and Microsoft, because some of those top names are businesses like I've never seen in my career.
Hi, this is Weronika. Today we will study the success of Joel Greenblatt, who is the founder and manager of Gotham Funds, an iconic value investor famous for making a 40% return on average for over 20 years, and the author of investing books, including The Little Book That Beats the Market, introducing the magic formula for investing. In this episode, we're going to break down the top 5 secrets to investment success by Joel Greenblatt. Let's get started. Find out what you're good at. Joel stresses what a meaningful role in life plays awareness and knowing what your circle of competence is, meaning what it is that you're truly good at. He points out that the very key to having a satisfying and happy life on a personal and professional level is not being an investor, a salesman, a financial advisor, or a manager. What it is finding that one thing that makes you stand out, that you enjoy doing, and that you can make a living by doing this for the rest of your life. This way, you get to work on whatever it is that you're passionate about, so you don't feel like you're actually working.
Usual, Buffett puts it better than anyone else. Understand what your circle of competence is. Doesn't mean you can't expand that circle of competence, but understand what it is and only play the game that you can play. So it doesn't mean don't keep learning and expanding your circle of competence. It means understand what it is and realize that if you play in that area, you can do very well, because other people don't. They're speculating or doing other things where they're doing things that they're not an expert at. Find out whatever it is that you're good at. And if you have an opportunity to make a living doing that, that's really great. And that's most of the advice I've given my kids. I didn't say go be an investor. I said, find out what you're good at, that you enjoy, that you can be successful at. You also have to make a living. But if you find that, that's really what your goal is. Find that thing.
Take advantage of an opportunity. Joel Greenblatt brings up the memories of his first full-time job on Wall Street when he was responsible for determining a risk arbitrage, which was not an appealing risk-reward business, so he decided he had to pivot. He explains how it all started when he started to look for opportunities when tracking a specific company situation and business condition, which led him to develop his investing strategy that eventually made him a legendary investor. What is crucial is that when you seek opportunities where no one else does, you have a high chance noticing something that others don't pay attention to. So they never get to have the same possibilities in the first place.
I started out, my first job on Wall Street, full-time job anyway, was doing risk arbitrage, and that's merger arbitrage. And basically when the deal goes through, as I told you before, you make $1 or $2, but if it doesn't go through, you lose $10 or $20. And that wasn't a very appealing risk-reward business for me. So I ended up looking around the sort of the perimeter of the deal, when there were different pieces of paper given out, or there was a company spin-off before the deal could get done, or whatever, anything that could get me out of risk arbitrage and into something else. And it turned out when companies are going through extraordinary change, there's a lot of interesting things that happen. Sometimes they're complicated. Sometimes little things get thrown away. So, there's all kinds of different things. And I started looking at all these different areas because the risk rewards were so much better. So one of the things, they happen a lot, but there's not, hundreds of things you can invest in all at once. So if you examine a situation, a special situation that, something extraordinary is happening in a business and it's complicated or it's obscure or, not everyone's looking at it for whatever reasons because, the regular analyst who follows that business doesn't really care about this little piece or whatever it might be. You actually can almost not invest or even gamble. It's kind of like cheating, where you know what something's worth, no one else is looking at it, and if you can buy it for a lot cheaper, it doesn't feel that risky to you. It's like, okay, I think it's worth $10 and I can pay 5. So if I'm wrong and it's only worth 7, that's Ben Graham's margin of safety. I can buy a lot of that. And I think we talked about years ago, basically, I didn't size my positions based on how much money I could make. I took bigger positions, and you're able to take bigger positions in things you can't lose much money in.
Understand that bad things can happen and prepare for that. Joel Greenblatt mentions breaking points that took place in his life, proving that one of the major lessons he would like to pass on to his own children is that regardless of what you do and how much you make, unexpected and bad things happen. And sometimes they are things and events you have never experienced in your life. As an example, he brings up COVID, which proves that any prosperous business can unexpectedly be locked down for months due to unpredictable circumstances that no one, including the smartest and most legendary investors, can predict. He shares a personal reflection on how he tried teaching his own children about how important it is to differentiate your investment portfolio and build your financial safety, so you don't end up investing your money in a one-stock portfolio and end up losing it all.
I have 5 kids, a couple of which I've taught investing or tried to teach investing to, and I gave to my boys who I was trying to teach investing at the time, that in early 2020 when COVID appeared, I tried to explain, I've been doing this a long time. I've never seen this, never anticipated anything like this. I've never seen where they just close down the world. Besides the terrible human cost, I'd never seen anything like this. And I just tried to explain to them that, I'm not going to be much help here. I've never seen this before, but it is a good lesson to learn that you have to be at least diversified enough and aware enough that really bad things can happen. And you have to live to play another day was probably the best lesson to learn, that you can't put all your eggs in one basket, and you can come back from big mistakes as well. I've made big mistakes with big positions as well, and then bad things just happen. And part of what I always thought you get paid for in this business is kind of your stomach. That what I enjoyed about getting into the business was, if you think well, and if you try to figure things out, it's not really count how many hours you showed up thinking that. It's the quality of your thought. And, in this case, it doesn't matter how well you thought, other things still can happen, and understanding that bad things can happen and preparing to survive to play another day is important. And so I think that was one of the best lessons. Of course, the market came back fairly quickly, so it wasn't, as painful as it could have been, but we didn't know that at the time. I mean, I remember watching Warren Buffett at his annual meeting right in the thick of things, maybe at the end of March 2020. I think it was maybe April 1, or I don't remember, not far after COVID started, and he didn't look like this was nothing, and it was a little frightening to see, because it was really staring at the unknown. And if you're looking at the unknown, one of the benefits of working for a long time in this business is, a lot of it is gaining experience, seeing a lot of things, contextualizing things, comparing things to what's happened in the past and what might happen. And this was fairly unique.
Why keeping things simple is the essence of human interaction. Joel Greenblatt talks about why one of the principles of life should be to keep the seemingly complicated things simple. He believes that many people get to overanalyze, overthink, or doubt the data they track or the people they look up to and take advice from, because very often the message they get becomes blurred, distorted, and too complicated to understand, so they second guess it. This is why his goal is to simplify every piece of information he passes on, so the listener gets to the essence of it, gets to understand it, and as a result, truly learns it.
It's been interesting, the process of trying to simplify what was I thinking, when I wrote "You Can Be a Stock Market Genius" about my years at Gotham and special situation investing. It was actually pretty easy to write because early on I decided, well, I'm not going to do a lot of research and on this thing. I just want to write down what was I thinking actually at that time, and why did I do that? Because if I didn't do the research before the book, well, why am I sharing something that I'm doing after I made the investment? And so boiling it down, what was I thinking at that time, and explaining it in the simplest form started me out there. And I also, after I wrote You Can Be a Stock Market Genius, and realized it was really written at an MBA level. And then I started, when I realized that when I started teaching MBAs, and realized that, boy, if you didn't have this background, you weren't really going to understand what I said in that book. And so sort of started me on simplifying things even more, because that wasn't the goal of writing a book to help a lot of future hedge fund managers. It was really to teach investing. And so when I had the opportunity at Columbia to teach, every time I thought of a new lesson to teach, or used an example or whatever, I tried to simplify it so that I could explain it better. And so just the practice of writing and teaching really helped me simplify to really get to the essence of what was I really saying.
The magic formula. Does it still work? Joel sheds more light on what he personally does with his own money and what kind of strategies of investments he prefers these days.
Most of my money is invested in diversified portfolios, more similar to the way the magic formula works. And that's because that's a full-time job. We run a big research team, a big tech team to implement those portfolios. Some of it's long short, some of it's long only. I also have concentrated positions in some really good businesses that you would know, like Google and Microsoft, because some of those top names are businesses like I've never seen in my career. That still do not look fully priced to me, that are just buy them and hold them, Warren Buffett type choices in my mind. Really, my full-time job is running these diversified portfolios, and it's not because I think it's a better strategy. I think I like them both. I think they're both full-time jobs, and I can only choose one. And I did one for 30 years. I'm doing something else that's fun for me. And so I like them both for different reasons. One's far less volatile. One's far still gets very nice risk-adjusted returns. And the other, the concentrated portfolios in cheap, good businesses also works incredibly well. So.
He also recollects the little book that beats the market, providing his thoughts about the ingenious magic formula and whether he believes it still works.
The fun of the little book was that I did not spin the computer thousands of times and say, these two items, cheap and good, okay, that worked the best, okay? I didn't do that. I said, let me think of a crude metric for cheap. Let me think of a crude metric for good. Split them 50-50. Put together portfolio and see what happens. That was the very first test we ran. It worked well. I wrote a book about it. It wasn't meant to say I spun the computer thousands of times and I came up with this and this was the best one. I said, this makes sense. And then we did one test, which I think is pretty valid, and it worked incredibly well and in order. Now, so I agree with the work that cheap also works very, very well. It happens to be more volatile, so it depends how you measure returns or risk, and I don't measure risk by volatility either. It also turns out that if you're buying big cash flow generating businesses, usually they're getting good returns on capital. But if you open a store and earn 30% returns on tangible capital, that's pretty good. Not many places in this world you can take money and get 30% returns, so maybe you should open another store. And of course, If you can open a store and earn 60% on capital, that sounds better. But the real question is, can I open 1,000 of those stores that earn 30% and only 3 or 4 stores that earn 60% before, that return comes down? Then which is the better long-term investment? It has to be good enough return on tangible capital. So when you're writing a book and telling people just buy a handful of companies, and you want to make sure they're cheap and good, not like you're buying thousands of companies and and this 200 will do better than this 200 or whatever. And you're not buying 200 companies. So I wanted to make sure people were safe and cheap and good. So I still think it's very valid. I won't argue with any of the data other than to say that if you just buy cheap, it does do better, but it's also more volatile. I run portfolios both ways, and they're both good. What I will say is that we've run a portfolio since 2010, I believe, that's just strictly buying cheap. It's actually cheap and good. It has an element of return on tangible capital. It's not 50-50. And that's done incredibly well, almost as good as the S&P 500, which is incredible, but it's a deep value portfolio, which has crushed any value portfolio during that time. And we also have a lot of data on, I call it the Value 1000. And we also have a lot of data of just ordering, it's about a 600 or 700 stock portfolio that's weighted towards cheapness, chosen from the 1,000 largest. And so but I have a lot of data over history on this portfolio. And what it would show you is the way it's priced today, the way we look at the S&P and where its valuation is, it looks like it's going to have single-digit returns over the next 2 years. Doesn't mean that'll happen. It doesn't mean that's adjusted for interest rates. Maybe it'll do better because interest rates are lower than historically. But if you look back and use the data for the last 30 years, apples to apples, it says, mid-single digit returns over the next 2 years. Whereas that value portfolio, using the same analysis, says, I think it's going to earn 35 to 40% over the next couple of years, based on past history. And so positioned very, very well to do well in the future. And, it looks to me like it'll easily catch up to the S&P and maybe exceed it. So that'll be good.
This is it for today. Thank you for watching. I hope you learned something new today thanks to Joel Greenblatt's fascinating insights. If you enjoyed this video, don't forget to like and subscribe to our channel. And of course, don't forget to watch other videos that we made for you.
He told Lilu and me that he wanted us to get together for lunch once a month. He basically pretty much instructed us that the two of you, I want the two of you to meet once a month for lunch.